This is kind of an interesting episode here because I have my accountant, well, I guess two of my accountants here that are going to answer all of your musician tax questions, all these things that you think that you can write off, for example, and then I ask these guys and they say, no, you can't actually write that off. Or sometimes you can write that off. Or should I buy something at the end of the year to offset whatever money I've made, all these kind of things. So why don't you introduce yourselves?
Okay, I am Alan Friedman. I'm a CPA with a firm called Friedman, Kannenberg Company. We're in the greater Hartford area of Connecticut. I've been speaking at NAMM since the early 90s. We do most of their financial education. Our firm services musicians, bands, indie labels, manufacturers of musical products, retailers, YouTubers, those kinds of clowns, and we've been doing this for almost 40 years. Well, I have, and this guy,
it's about 15 now.
Yeah.
I'm Evan Kalish. I've been doing this for now 15 years. I'm an enrolled agent with the IRS. I've been with Alan for about 8 years now.
Right.
Came from a much larger firm. Where I learned a lot, international tax, state and local tax, and I've been a drummer for most of my life, mediocre at best, but fun on the side. And this synced up perfectly, finding a firm, with Alan that specializes in the music industry.
I forgot to tell you, I've been playing guitar.
Alan's an excellent guitarist.
Thank you very much. That's a little bit of an overstatement, but people always say you're an awesome guitar player. For an accountant.
No, he actually, shockingly, is an excellent guitar player.
Thank you. And I know you're not going to ask me, so I'm just going to offer it up right away. My favorite guitar player, you have Hendrix back and everything. My favorite guitar player, bar none, Steve Lukather.
Oh my gosh.
Sorry. It's okay.
Okay, so let's get down to this.
Yeah.
What are some of the myths that people have about things that you can write off? Because let's talk about write-offs first.
Okay.
Sure.
So the law is simply this. You can deduct any expense as long as it's incurred in the production of income.
Give some examples.
Yes, if you're a musician or a band, the gear that you buy, recording expenses that you incur, travel costs, if you're paying for iTunes, Spotify subscriptions, those kinds of things. Anything that you incur in the production of income in your craft, your trade or business, is deductible. Okay. The working musician is trying to hold on to as much income as they can, like most Americans. And at the end of the year, when they start staring at larger tax bills, they're constantly looking for ways, legitimate or not, to...
Don't look at me,
No,
Alan.
I'm not. Rick,
we make sure it's all legitimate on your side.
Yeah, they'll look for ways to reduce taxable income. And here's one of the biggest myths. This is actually, I tell this to every one of our clients. When you're a cash basis taxpayer, which you are, which means that when you receive income, it's taxable. When you spend money on legitimate business expenses, it's deductible.
And this goes for primarily most musicians, bands, recording studios, cash basis taxpayer.
That's right. The end of the year, you're staring at some large tax liability. I'll give you an example. Let's say you took in $200,000 of income during the year. You had a good year recording, touring, that kind of thing. And let's say you had $50,000 of legitimate expenses. So you're staring at $150,000 of taxable income. You're probably looking at between federal, state, self-employment tax, probably something close to $40,000, $50,000 of tax.
Unless you're in one of those non-tax states, those nice ones.
Right. So musicians start thinking, oh, well, let me empty my checking account and buy stuff.
I hear this from my friends all the time.
Yeah, exactly. I need to buy gear and
to get the write-off.
To get the write-off, okay?
Yeah.
And yes, for example, that $150,000 net income, if you were to spend $50,000 on gear, well, now you're dropping your taxable income down to $100,000, and you're probably going to save $10,000, $15,000 of tax. So now your tax bill is not $50,000 anymore; it's like $35,000. Yep. Here's the question I ask every one of our dumbass clients. Okay, I say, "Do you need that equipment?" No, not really. I got plenty of guitars. I got plenty of mic pre's, and I'm doing recording. I don't really need it. Well, then why are you buying that stuff? Isn't it better that you just pay the tax and have, of that $50,000 you're thinking about spending, pay the $15,000 tax, you still got
Keep the rest.
$35,000 left over.
Right.
Instead of spending $50 on stuff you didn't need.
What about things like, I'll give you an example here. I pay for YouTube Premium, which is, I don't know, $12.95
Yep.
a month.
Right,
Yep.
right.
Now, is that a write-off?
Fully deductible.
Absolutely.
Yeah,
Any
especially in
type
your
of
business.
subscriptions that you're using inside of your business to generate income, as Alan mentioned.
So all the subscriptions, like for plugins, for example, a lot of us use plugins for Pro
Absolutely.
Tools.
Totally. All
Right,
of them.
and all those are deductible.
Yeah.
You're selling that music as a producer or an artist. In your case, you're using those plugins to edit YouTube content, absolutely deductible. It's generating income.
Right.
And for example, if I have LUTs for film, like for color correction,
Yeah.
things like
Yes.
that, all these things
Yeah.
Absolutely.
related
That's
to
your
the,
trader business. That's how you make income. The funny thing about gear, when you're buying an asset that has future value, like a car or a truck that you're using in your business, but we'll stick with gear. That's a good example. You're supposed to depreciate that over.
Okay, explain this.
Okay. Depreciation is just a fancy word for an elongated write-off of that asset over its useful life. So if you were buying some computer gear, let's say you spent that $50,000, you bought all kinds of recording, your computer-based gear and recording gear.
New Mac Studio.
Yeah,
That's
right.
the whole 50,000.
That's right. That's right. So you spend $50,000 on a bunch of stuff, guitars, whatever. You're supposed to depreciate that, meaning if the IRS says, well, that has a 5-year life, then you're supposed to write it off over a 5-year period. However, there's a really cool part of our tax law called Section 179, where if you're, and most accountants know about this, you make an election on your tax return to write it all off in 1 year, and you get the deduction all in 1 year.
Okay, so let's say I buy a Gibson SG for $3,200,
Yes.
$3,000, to
Right.
keep it easy. If I take this deduction all in 1 year,
Yes, you get
Is it-
you get $3,000 deduction,
Right,
which is
so-
going to save you $1,000 in tax.
okay, explain that
Right.
part of it.
Okay, so
Because people are
3,000.
thinking you spend $3,000, you're saving
saving
$3,000 in tax.
$3,000.
You have no idea how many of our clients
most
think
people
that.
think this.
Yeah, they,
Yeah.
you know, like, or my spouse doesn't need to work because it's all taxable, and I'm going to put them. They're going to put me in a higher tax bracket. That's ridiculous. You only, if your spouse went to work and made $100,000 and 3 in a higher tax bracket. So okay, so now maybe you're paying $40,000 in tax, federal and
Yeah.
state tax. You still got $60,000 left over. Put your spouse to work.
And in that situation, to be the really boring guy in the room, because Alan's animated and fun, we have
really.
a progressive tax system. So if your spouse goes to work and earns an additional $10,000 more than you would have, as a couple, if the $10,000 is in a new tax bracket, that doesn't mean the whole bottom part of your income is now also in that tax bracket.
Right.
So you're
It's
taxed
just
at-
the additional.
Right, you're taxed up to, let's say, 30%, and then if you move up to the next tax bracket, it might be 33% or whatever it is.
That's right. It ends at 37%.
Yeah.
Yeah.
There's some other little nuances, but generally speaking, that's how it works. So you're never, if you made $100,000, you're not paying $100,000 in tax. Maybe you'll pay $30,000, $35,000, $25,000, depending on what bracket you're in, how much other income you're lopping on top.
The point is to take advantage of every deduction you're allowed. And sometimes there are some gray areas where you can not necessarily push the limit, but also fall into a deductible category that you could justify and pay the lowest amount possible in tax. But afterwards, if you're left with a ton of tax, as Alan likes to say, that's great because you made a ton of money.
Right. There are some nuances by being a musician or band, like for example with recording costs.
Okay.
They're not necessarily all deductible in 1 year.
Why?
There's a thing called the Uniform Capitalization Act.
I thought I was going to be the
Section
boring guy.
263A, where you're supposed to write it off over a period of time that's equal to the revenue that you're going to earn on those recordings. But there's a safe harbor, which means, okay, we're going to give you a break. You make
As long as you do it this way.
That's right. You make an election, do it this way. You can actually write those costs over 3 years. I believe you get 50% the first year, 25 the second, 25 the third. So you get it over, okay, maybe not all in 1 year, but over a couple of years.
And it's interesting to see that too, because that's a sort of an old rule And there's more things that need to keep up with the times. So I'll give you an example. As a content creator, you think about that. Okay, so in Alan's example, you recorded this album. The life of the revenue stream is really happening within that first 3 years. I would argue, from a content creation standpoint, the life of that revenue generation is really taking place in the first 3 months, 6 months at the most.
Yeah.
And so as these rules change, as there are more IRS court cases that come out on the content creation side, I think we're going to see some differences between that and like recording studios and musicians and bands, but also some similarities.
Right.
Okay, so I'm starting a new business. I'm going to become a YouTuber. Am I going to start an S-corp, an LLC? Everybody talks about this. Oh, I'll just do an LLC. What are the benefits of having an S corporation?
Yeah.
I'm going to let Evan answer that,
Evan?
but I'm going to tell you one
Okay.
quick thing before I let him speak.
Go for it.
No, just. When you start a new business and you're incurring costs, hiring a lawyer, maybe the articles of incorporation if you happen to incorporate, or you're putting money into some intellectual property, or you're building things before you even take in $1 of revenue. Those expenses are not deductible in that first year if you haven't earned revenue. They become deductible once the business is deemed to be operating, which they define as earning revenue.
What if that doesn't happen for 3 years or something?
We see it all the time.
Yeah, you may never get to deduct those expenses because then the question becomes, was it ever really a legitimate business as well? I'll tell you another thing a lot of musicians like to do is they have a job. Let's say they're working someplace, working for a music store, but then they're gigging. And they got W-2 income from the music store, but they want to lower that income. So what do? They start deducting their musicianship income, and they're running a loss every year because they're spending all kinds of. They're just spending
This
more
is actually
money.
probably more common for people
Oh my
watching
God.
this.
Oh, absolutely.
Yeah, so they've got revenue coming in, but their expenses far exceed their revenue. So that's okay for the first year or two. You can't continually do that. You run the risk. It's what's called the hobby loss rules. The IRS can come in and say, this is nothing more than a hobby. And really, it probably isn't anything more than a hobby because who in their right mind would continue to run a business that loses money?
They'll come back and reclaim that loss down to zero.
Yeah.
And you'll pay not only the tax that you got the benefit for from taking a loss, but you'll have some penalties and interest attached to it too.
Exactly.
It's wild.
All right.
Entity type?
Yeah.
Okay, the most fun part of the day. So the thing that
Just riveting, isn't it?
Oh, it is.
This is.
Okay.
If you haven't stopped paying attention yet, now wouldn't be the time. So the thing that really sort of gets me is some short form content that's out there these days. And we get these questions a lot from new clients coming in and even existing clients who watch the short form content and see something like, within a few seconds, I started an LLC to take more tax deductions against my income. You should start an LLC too. An LLC, as a prime example, is a legal concept in nature only. It's to protect liability. So in our field for bands and musicians and studios, there's no true tax difference between a single member LLC that you start and just a sole proprietorship that you haven't attached legal protection from an LLC to yet. They both go on the same Schedule C. You're allowed the exact same deductions, whether you have that LLC or not. So right there, let's put that to bed. Sole proprietorship, LLC, same taxation.
Right.
Talk to your lawyer about if you need an LLC.
Okay.
Now we're talking about S-corps. S-corps are kind of a gray area. My sort of hard and fast rule is if you have anticipated profit in your S-corp, all the money you make minus all the deductions you're allowed, if your anticipated profit after that is going to be greater than, say, $150,000, it is likely tax advantageous to start an S-corp. Why is that?
Interesting.
S-corps have a little bit of difference. Where you have those LLCs or sole proprietorships, all of your profit, your taxable income, is subject to self-employment tax.
Social Security and Medicare.
Social Security and Medicare. With an S-corp, any profits you have after you take what's called a reasonable salary, running payroll for yourself as an S-corp owner, Any profits remaining after that aren't subject to that self-employment tax, the Social Security and Medicare. Now, I say $150,000 because with an S-corp, you have some added fees and expenses that you won't have on the single member LLC side or the sole proprietorship side. Here's the examples. S-corp files its own tax return. You're going to have additional accounting fees for another tax return every single year.
Right.
You're also required, as we said before, to set up payroll for yourself as an owner, or if you have multiple owners, sometimes people own with their spouse, and run salary for yourself. So now you have payroll costs. You have the cost of running payroll, whether you're using a payroll service or you're doing it a little cheaply, on your own. There's going to be an additional cost for that. So once the tax savings exceed the cost of the operating of the S-corp, that's when I see it make sense. It's usually around $150,000 in profit.
Yeah, let me add a little story. So we had a singer-songwriter who was touring, made a couple $1 million net of income,
Profit,
very
yeah.
successful, and came to us as a client. And the prior accountant had him, this particular singer-songwriter, take a $500,000, what they called reasonable salary. So he made $2 million, took a $500,000 of W-2 wages salary, and $1.5 million left over of profit, which came through in his S-corp on a K-1. So when you look at the personal return, on one line you got $500,000, on another line you got $1.5 million. So it adds up to the same $2 million. Except the $1.5 million, he didn't pay any Social Security or Medicare because it was an S-corp flow through of income. The IRS came in, audited this. Thankfully, we didn't do the return. We just had to defend them in the audit.
Yeah.
And they said, he didn't take a reasonable officer salary. Well, he took a $500,000. Yeah, but he doesn't have a band. He was a singer-songwriter all by himself.
All the profits
were due to him. His reasonable salary was $2 million.
Wow.
So they whacked him for another, for Social Security and Medicare tax on $1.5 million. Now, he happened to be over the Social Security limit, which these days is about $170,000.
Yeah, it's about $170,000.
Okay.
So realistically,
but he had Medicare tax on 2.9% roughly on that other $1.5 million.
that they reclass.
So those are some of the quirky things in the music industry and musicianship that you have to be aware of. Now, if he had a band, we could make the argument that the band was earning the income. It wasn't just him.
Okay.
So, but that wasn't the case.
Okay, what about people that say, I'm going to start a corporation for my music business thing I'm doing, and I'm going to lease a car because I'm going to get a tax benefit from that. You guys hear this all the time, right?
That's another one of those short form videos I love of
Yeah.
how to get a free car through your business.
Right. And it's going to be a Maserati because that's what I use for business purposes.
Okay, so what's the actual real deal with
Okay,
this?
so here's the real deal. You get to deduct the use of your automobile for its business use portion. Okay, so what's the business use portion? Well, it's the miles that you drive for business purpose. Okay, if you're driving to, let's say you're working out of your home, you're recording, you're at home making music, learning music, recording music, but you're driving to gigs, you're driving to the post office, you're driving to Guitar Center or your favorite music store, wherever. Those things you're driving for business purpose. You're supposed to contemporaneously, big word, according to the IRS, you're supposed to keep track of your mileage as it's happening.
A diary of a log.
Exactly, a log.
Yeah.
Ask us how many of our clients actually keep
Zero.
a log. Yeah, like
We tell
pretty
them all
much.
to do it.
Yeah, pretty much nobody. It's amazing though how many have a log the day of the audit. Okay, okay, because we tell them, dude or dudette, when you show up for the audit and we're sitting there representing you, don't not show up or don't get, make sure you give us a log, because if you don't have a log, they're going to throw that auto deduction out. So you can either take the mileage rate, the IRS prescribed mileage rate in effect for that particular year. Maybe it's 65 cents. If you drove 10,000 business miles, you'll get a $6,500 auto deduction. Mm-hmm. But you have to keep track of your business miles. If you were driving to your studio which was in a different location, from your home to that studio, well, that's commuting mileage. And that's not deductible.
Yeah.
It's only when you leave the studio to go someplace
Wait,
for
what?
business purposes. Yeah, exactly.
Yeah.
Wait, so if you left the studio to go get lunch, is that mileage deductible?
Was the lunch for business purpose? Well, if you went to have lunch with your accountant,
Right?
Then-
then
yes.
yes. If you went to have lunch because your wife told you to pick up something at P.F. Chang, no.
Okay, so if we went to lunch and I picked up the tab, is that deductible?
Okay.
Because people talk about this, oh, we talked about business.
You know, I love being at the NAMM show and clients go, well, you should take me out to dinner because it's deductible. Yeah, let me tell you how deductible it is.
Right.
That $1,000 dinner because you drank so much, basically 50% is deductible. So I'm going to get a $500 deduction. And I'm really going to save whatever my tax bracket is. So let's say it was, federal, state, let's say it was 40%. So I'm going to save $200 by buying you dinner.
On the
It cost me
$1,000
$800,
Right.
okay.
Yep.
So Alan, if you take someone out to dinner, you pay for it,
Yeah.
you want to have a business credit card for something like this,
Yes.
right? Makes it easier to keep
Yeah.
track of, is that correct?
That's a great
And
practice.
even if you have an LLC, you can have a business credit card or no?
Yes, and in fact,
Absolutely.
you should have one.
Okay.
Yeah.
One thing Evan said before, which was very, very astute, surprising.
First time.
Yeah, right. Is the reason to incorporate, or whether you form a limited liability company, LLC, if you have a partner, it can be a two-person LLC, or you start a corporation, has really very little to do with taxes, as Evan alluded to. It has to do with limited liability. If you are a band and you're touring, you kind of want to be either an S-corp or an LLC. God forbid a speaker cabinet falls on somebody in the audience's head or something like that and they sue you. You want to put a brick wall between the band and its assets and your personal assets. You don't want them coming over your personal assets,
Yeah,
right?
and I would argue a component of that brick wall is establishing that LLC.
Yes.
And keeping everything completely separate. Like Rick, when you were asking about should I get the business credit card when I establish the LLC? Well, a couple things. You may need something like an LLC or at least an EIN number with the IRS.
To get a business card.
To
Right.
get a business card.
right.
Yeah.
You don't
To
necessarily
open the
need
bank
the LLC, but you'll need to get an EIN as a sole prop. But the best thing you can possibly do forevermore, even if you have to fund money into that business bank account personally first as a contribution, is to use that bank account and that business credit card for everything business. Keep everything personal separate. It's going to do two things. It's going to help you in record keeping and providing documents to your accountant at the end of the year so we don't have to sift through it and charge you obscene hourly rates to go through your box of receipts from your business credit card and your personal credit card and what is what. So that helps. But it also helps to really cement that wall that Alan's talking about, that you established the LLC, for that purpose originally.
Right. And by the way, accounting expenses, accounting fees, they're not an expense, they're an investment.
No, but you write these off.
Yes, you can write it off. yes.
Okay, legal expenses
Yes.
related to your business.
Related to your
Yes.
business, absolutely.
What about when somebody gets audited and if they have to get a lawyer or something like that?
Tax
for that?
attorney,
Yeah,
tax
yeah,
accounting
totally
fees?
deductible.
That's deductible.
Professional fees.
This is another thing I hear from friends of mine. I got paid in cash from my gig. They paid me $3,000, but I'm not going to declare that.
Right.
I'm going to spend it on groceries for the next
Right.
whatever. Or I write somebody a check and they go to the bank and cash it, and they
Yeah.
think that money is, the IRS doesn't know it because they've gone to the bank
Right.
and cashed it, and they don't know that that's income.
Well, let me ask you a question.
Use an Alan
Yeah,
phrase.
What color orange jumpsuits do you like?
Yeah.
Okay.
To go along with
Yeah,
that,
yeah.
everything's fine until you get caught by the IRS. Notice how I didn't say legal. Everything's fine. It's not legal. You have to claim those cash receipts. And not only that, but we also hear in that vein, hey, so I was paid less than $600 by X band member or
Club
Y
or,
venue.
yeah, right.
So they didn't send me a 1099, so I don't need to claim the income I made there.
I hear this from friends.
Yeah.
Tell me
Let's
this.
say you did 100 gigs at the $599.
Yeah, right.
Okay. Is the IRS going to say, okay, you don't have to declare that $59,900 worth of income?
Yeah. In my view, the IRS is putting that rule into place, the $600 rule, to make it so it's not overly burdensome, but at the same time catch the big pieces.
Yeah.
But the rest of it is still both declarable and taxable in the same fashion as if you received a 1099.
And by the way, the party that's paying you the money is supposed to issue the 1099. And if they do it by check, they won't be able to deduct it in an audit if they didn't issue you a 1099. So you have, a promoter, a club owner, or even within a band, like we see 5-person band, but one person's taking responsibility for all the receipt of money, goes into their checking account, and then they're paying out the band members. And let's say they took in $100,000 and each person made $20,000. Okay, so the 5 members. So the $100,000 comes into party A, the guitar player, let's say, and then he pays the singer, the keyboard player, the bass player, and the drummer $20,000 each. Well, on his personal tax return, he would show $100,000 of income and $80,000 of contract labor, and only pay tax on $20,000, as long as he issued 1099s to those 4 guys.
By what day, Alan?
So it's supposed to be in the hands of the recipient by January 31st, I believe.
January 31st. And you think of it the other way, too. I have this conversation.
After the end of the year.
After the end of the year. I have this conversation with clients all the time. I said, think of this in reverse. So you're getting paid by your guitar player who's collecting all the money, and every 1099 from every club is issued in his name. And you say to the guy, hey, you know what? There was only like 10 grand this year. Maybe you don't issue me a 1099, because you're thinking, well, I didn't get 1099. I don't have to declare it, which is wrong anyway, as we just discussed. But think about your guitar player and think about the deduction they'd be missing out on if you don't properly have that 1099 declared to you as well.
Right.
So again, we're not in it for people to pay any more tax than they're required to pay.
We don't work for the IRS. We work for our clients. But
there's a right way to do it.
We want to sleep at night. We want them to sleep at night too. So
let's say that I have a side thing, trying to make money as a musician, but I have a regular job.
Yep.
And I'm outfitting my studio with sound deadening stuff for the walls.
Mm-hmm.
But it's not Auralix that gets glued on. Let's say it's actually becomes you permanently affix things.
Yes.
Okay. Now, is there a difference between gluing the Auralix and permanently making
great question.
Permanently making it part of the structure of your room?
Yeah. If you have leasehold, we call them leasehold improvements that are permanently affixed to your home.
I mean, you understood the
totally,
question, right?
Totally
structural framework versus...
Yeah, like you actually build a legitimate bass trap or something
right,
that's part of your room.
Or a vocal booth or something like that. You're going to love this. You're supposed to write that off over 39 years.
Mm-hmm.
What?
It's commercial space.
Okay.
Okay, if it was residential, like if you had a residential, like you bought a home and you were renting it to somebody else, that gets written off over 27 and a half years.
Okay.
Here you're talking about a commercial space. It's your studio. Yes, it's part of your home, but it's now you've deemed it to be commercial. So you write it off over 39 years. Now, there is some new rules that came out not too long ago that says, well, if it's qualified improvement property, you may be able to write it off over a shorter period of time, 15 years, or take what they call bonus depreciation. Yeah. So there are some legitimate ways to write off all in 1 year those costs.
There's legitimate ways, and the important component of this is a lot of these laws, like Alan's talking about qualified improvement property, a lot of these laws are changing as time goes on and either expiring at certain points or phasing out as time goes on, and we're constantly following what is either going to be renewed, changed, adapted over time. So like in Alan's example, for something that's not permanently affixed, that you normally deduct over 39 years, hey, it's qualified improvement property, great. It's over 15 years instead, and I can take bonus depreciation.
Yeah.
When that first came out, they put that into place because bonus depreciation was deductible 100% that year. In the last 2 years, that's been phasing down 20% each year. Yeah. So now if you have this qualified improvement property that your accountant 2 years ago told you, hey, if you get qualified improvement property, you can deduct the whole thing in 1 year. Now you're only getting 60% of it in the first year. And this coming year, it'll be 40%.
Changes.
Unless they change the laws, which we're due for.
And the laws are constantly changing, especially with every new administration. There's invariably new laws.
What do you recommend if you're going to put on acoustic treatment? Do you make it and just hang it on the wall so it's not part of the structure of the house?
Yeah, that's a great question. Ultimately,
if you want to get the write-off, what do you do?
To me, I wouldn't affix it to the house.
Yeah, here's what I'm going to tell you. You're a professional.
Right.
You're Rick Beato, okay? You can hear things that the rest of us can't hear. You know that rooms need to be built out certain ways, and they need to be acoustically treated, and they have to be done the right way. In recording studios, they have obviously subflooring and things like that nature. So my advice would be do it the right way. We'll worry about the deductions and how much you get. It's that's another big myth or a big fallacy. Where people make decisions solely based on tax deductions.
That's true.
And they ignore the economics or the benefits of why they're building that studio out in the first place. So if it would be better for you to just build permanent baffling that's affixed to the wall, that doesn't come apart instead of foam, or in your case, eggshell, egg cartons. Thank you, that are stapled. You need to do what's best for your business first and foremost, and then the taxation issues get dealt with afterwards.
Okay, so I obviously do YouTube and Instagram and TikTok.
Yeah.
When I get my hair cut, is that deductible?
No.
Okay. When I buy clothes or anything like this from Target, is this deductible?
Rarely. You want to know an exception?
Yeah.
Your clothing?
I asked this for this because I
Okay.
know this.
Yeah.
So explain this.
For you, no. and here's the reason why. You can wear that to a party. You'd probably wear that speaking to Congress. Okay, you can wear that at NAMM. Those are normal clothing. I had a musician client who was on tour, and he had a deduction of $2,500 in theatrical clothing. He got audited, got down to the last issue. It was like going really well. No change audit so far. We're down to this last issue. Sitting with the IRS agent, and she says to me, "Oh, we got a clothing deduction." No, we're not going to allow that. And I said, "This theatrical," and she goes, "No, you know the rules. If this can be worn outside and to a party or on the street or something like that, you can't deduct those expenses." By luck, I happen to have in our tax file the tour program. This guy was a guitar player who was touring with Joe Cocker years ago. I happen to have the tour program, and I open it up, and there he is in pink satin pants, leopard skin top, like purple satin shirt. And I said, "Well, how about this?" And she looked at it and she goes, "Okay, fine. See ya." So, yeah.
So only outrageous looking things that you would never wear in public?
Yeah.
Uniforms or really wacky clothing.
Okay, what about things like royalties? Let's say sound exchange.
That's an excellent question.
It's a perfect spot for it.
Yeah. So musicians who compose music, there's royalty income that comes in, sound exchange, or whether it's coming from BMI, ASCAP, stuff like that.
Yep.
Okay, they get a 1099. In that box, that dollar amount that they received is under royalties. Okay, Evan, talk about Schedule E.
Yeah, I'd love to. The boring part again. Thank you.
We get all excited about this topic.
So 9 out of 10 new clients that we see come in that have royalty income have either like an S-corp business set up, or maybe they have a Schedule C on their personal return for their music business. And there's a code that shows them as an independent artist or performer, which the IRS can tag to, and any income that's reported through that Schedule C is subject to self-employment tax, like we were talking about earlier. To Alan's point, when you get a 1099 from royalties from SAG-AFTRA or BMI or wherever it is, it's going to be on a line called royalties on this 1099, and any reasonable accountant who doesn't know the industry is going to put it on Schedule E on your personal tax return.
Under royalties.
Under royalties, you would think, right? That makes perfect sense. Until you get audited and the IRS goes back to your Schedule C, sees on that line for the NAICS code that you're an independent artist and performer, they're going to go, I don't know, that royalty income is actually supposed to be on Schedule C. subject to self-employment tax. It's the biggest mistake we see, and it's the one that I hate the most because I have to tell these new clients coming in, hey, the mistake isn't going in your favor. We're going to fix it, and you're going to pay a little more tax than you paid with your last accountant.
Because royalty income, this is true for book writers, composers, is part of their trade or business, earning royalty income. If you were an inventor and you invented something and you were getting royalty, you invented this product and you licensed it or sold it, and you got paid a royalty over a long period of time, and that was your only invention. You're not in the business of inventing stuff. You just happen to invent something. You're getting a royalty stream. No problem. That can go on Schedule E.
Would that be like if I'm Floyd Rose and I have a patent on the Floyd Rose tremolo and you get royalties from that or whatever,
That is royalty income.
I think there's a point in time when you can reasonably switch it over from the schedule that's subject to self-employment tax.
Did Floyd Rose invent anything? I only know the tremolo. Did he invent anything else?
He's invented a lot of different things. He has a lot of patents, actually.
Okay. He's probably, that's going to be subject to self-employment tax. He's in the trade or business of inventing musical instrument products.
What's the thing that your clients get wrong the most?
I'll give you one that Evan deals with all the time. You get taxed for state purposes. People think you get taxed by where you live. It's actually you get taxed by where you work. Now you happen to live in Georgia and you work in Georgia, so you're going to pay Georgia state tax. Bands, especially up in, we're in Connecticut, we're right between New York and Boston. It's not unusual for a band in Connecticut to be touring in New York, Massachusetts, New Hampshire, Vermont, Maine, New Jersey, Pennsylvania. I mean, you can get to all those places in 5-6 hours. So you have this, here's a crazy, you got a band, a young band, 5 people. They have an LLC. It's a partnership, but it's treated like, it's an LLC treated like a partnership. They start earning, I'm going to let Evan give you the punchline. They start touring in all these different states. Mm-hmm. Not making a lot of money, but they're getting their band known, what have you. Yep. And let's say they make, an elongated tour, let's say $200,000 of income, and let's say they had $190,000 of expenses between, auto, lodging, meals, and everything like that. So they made $10,000. Okay, so they have to file a federal return for their LLC on a partnership return. They also have to file
state tax returns for every place they touch down in, to a degree. There's some sort of reasonableness where you start looking at state-by-state exemptions, where either your gross revenue wasn't high enough, or your net revenue, or a handful of different ways that you calculate what they call apportionment, to see if you're required to file in a given state. So it might be 2 of the states you might have to file. Maybe
if
so.
If you made over X amount, if that's their whatever their law is.
We have a client, we have actually a few clients in the Rolling Stones production crew, also sidemen. It's not unusual in a busy year and they get paid correctly. They get paid as an employee, because they're under the control of the Rolling Stones organization. They're told where to show up. Their salary is negotiated in advance. It's over an elongated period of time. There's reasons why they're deemed to be an employee, not an independent contractor. At the end of the year, those people will usually get 1 federal W-2 and like 30 state W-2s. Yeah. And each state, because they use a really good payroll service, they break out that big salary into the 30 different states, and they show the 30 different state taxes that were withheld for those states. Theoretically, we're supposed to be filing 30 state returns in addition to the federal return for that employee.
But just like the bands, we look at it from a reasonableness perspective and what's actually required state by state. So if I got a guy coming to me with 30 state W-2s, and their prior accountant said, I had to file in all 30 states, and what does that mean? Well, drastically higher accounting fees, because now all of a sudden you're filing in 30 states. If I see that same W-2 and I see $1,000 sourced to Arizona, maybe you did 1 show there, and that's your day rate as the band member or the production staff or whatever it is, and I got $1,000 to Arizona, and I have $45 of Arizona tax withheld. I go to that client after I look at the Arizona exemption chart and I say, hey, you're under the exemption where you're required to file there. You only had $1,000. You're not required to file in Arizona. They won't come after you if you don't file. What's the cost benefit? Well, I got $45 as Arizona withholding that I could get back. What's your accounting fee going to cost to file in that extra state?
Yeah,
$250. We're not filing in Arizona this year.
Right.
So you start with what you can eliminate, and at least in our opinion, you start with what you can reasonably and legally eliminate state by state and file in the remaining ones that you're required to. Or in that same example, let's say your earnings in California are under the threshold to file, but you have $1,500 of California withholding. It's going to cost you $250 more to file there. Go get that $1,500 of withholding back,
right,
even though you don't have to.
The worst scenario is when you have, as I was alluding to before, a young band made $200,000, spent $190,000, has got 10 grand, and now you're allocating the $10,000 of income among 10 different states. And think about this, so that you've got one federal return, 10 state LLC returns, 5 individuals who get K1s, a federal K1, and 10 state K1. You're talking about 50 individual returns on top of the 10 or 11 partnership LLC returns. We like to apply, now what I'm going to tell you is not technically correct, but we apply the cost benefit analysis, which is it worth the cost of incurring all those accounting fees to file all those returns in all those states for the entity and the 5 individuals to allocate, what's going to amount to $1,000 or a couple $1,000, or sometimes it's losses.
Yeah.
We don't do it.
Yeah.
We'll do it in certain circumstances. So you ask any accountant any question, what their favorite answer is? It depends. And so there's an it depends. I would tell anybody watching this to check with their tax advisor, but that's kind of how we do things. But when you have a band that's really touring and making a lot of money, and they're being paid, the band members are being paid a lot of money, and they're in a bunch of different states, we're filing in all those states.
You're probably registered in all of those states with your
states know that
entity
you're
and
there.
with the payroll too. So
Yeah.
I would say the best advice that I could give to either a touring act, the act itself, or if you're a hired gun on that tour and you're getting a W-2, is talk to your accountant about both what's reasonable and what's legally required
Right.
to file. Because there's ways of both shortcutting the process and diminishing the actual, filing requirements themselves and what you end up filing, where you can save yourself accounting fees, time and headache, possibility state letters, but still be compliant the way you need to be, or in that other example, get refunds you might be entitled to.
Right.
What about if I'm a guitar tech for some band and I tour for 3 months,
Right.
and I'm getting per diem every day? I'm getting $45 a day.
Right.
Is that per diem taxable?
The government publishes what they call per diem rates. And you can go to GSA?
Yeah.
Yeah, okay. You go to this particular government website, and you can look up what the standard deductible amount is for lodging and for meals and incidental expenses. There are 2 different rates by location. So, one for New York City is going to be a lot higher
because
than
more
one
expensive.
for
Alabama?
Yeah, Alabama or Albany, New York. If you can prove that you were away overnight for business purpose as an independent contractor,
The part-time that you were talking about.
1099, you're getting paid 1099, and you had to incur those costs while being away, yes, you can deduct the cost of lodging and meals and incidental based on those particular charts while you're away if you're an independent contractor. Now, if you're getting reimbursed for any of that, well, that's income.
Okay.
But chances are the deduction is greater than the income that you're being reimbursed.
Now
If you're an employee, you don't get it.
Okay, let's say that the other 9 months of the year I work for Guitar Center,
Yeah.
right? So I'm getting a W-2 from Guitar Center.
Right. 2 separate sources of revenue, 2 separate activities.
So the first 3 months that I'm a guitar tech, is a completely different.
That's a
Now,
completely
could
different
that be under my LLC?
If you own that LLC 100% by yourself, it doesn't have its own tax return, but it does have its own reporting on your personal return on Schedule C. If you happen to have a partner in that business, then it would have a separate reporting on a LLC partnership return with the box LLC checked off. The two partners get K-1s, and they each report their income on each Schedule E, page 2, of their individual return. So the income flows through on your personal return.
Yeah, and to add to that, I would make the argument that in your example, Rick, when you're receiving a 1099 for these 3 months, that's its own income generation. If you have incidental meals or like unreimbursed hotel charges or per diems while you're generating that income, that's where it goes. If you're working at Guitar Center the other 9 months of the year and you go out with, you know, one of your buddies who's also an employee for lunch, it's not only connected with this income where you wouldn't get a deduction, but as a W-2 employee since 2018, there's no expense you can deduct against W-2 income anymore anyway.
You used to be able to.
It's
So you
kind of
can't write off that lunch.
Yeah, on itemized deduction Schedule A, you used to be able to write off unreimbursed employee business expenses. They did away with that.
Okay, so what's our final takeaway here? What's the most helpful thing that I can do as a musician to make my tax accounting the easiest at the end of the year? Is it have a credit card that you only use for business, and then for your personal thing, you use your personal debit card or whatever?
All right, I'll give you mine. I'm sure Evan has one. I think the best thing you can do is get some, you know, some quality, it doesn't have to be expensive, accounting. So Quicken is one of my favorite, you know, or QuickBooks, but Quicken's easier. Just keep track of the money coming in. You can do some amazing things with PC. I mean, that software is like 50, 60, 70 bucks, runs on a Mac, runs on a PC.
Is the software deductible?
Of course it is.
Absolutely.
Because you're incurring it in the course of the
Unless you're a W-2 employee.
Right, but that's right. But if you're a musician and you're keeping track of your money in and the expenses going out and Quicken, at the end of the year, you literally hit a button to print a report and it spits out the total amount of revenue that you took in. You can have it broken out by the source, and then all your different expenses, utilities, music equipment, supplies, gear.
My best advice is right in that same vein. I like to tell my clients, start with something that you can figure out works for you. Alan's favorite thing is, if it's clean, I'm okay with the sheet of paper where you give me your total income and your expense totals by category. That's fine. If Excel works for you, that's great. If something like QuickBooks Online, which is a little more beefy, and a lot of our clients require that, especially with interstate touring or international touring, if that works for you, that's great too. Start with what works for you, and then work with either your current accountant or if you're switching accountants, and see if the form that you produced it in is helpful to them, or if there's any tweaks that they recommend you making to save them time or save you time going forward. But start with what works for you and then tweak it as the years go on.
Well, this has been incredibly helpful, guys.
Love doing this.
I'll put it in the description if you want to have these guys work with you. And
Thank you, Ray.
Yeah, no, this is wonderful.
Thanks for having us
and
on.
thanks for doing a great job for this industry. We're here at the NAMM show, and walking with you is incredible because you can't get 3 feet without someone coming up and saying, love your channel.
Cool. All right. Thanks, guys.
Okay, we'll
Thanks.
see you.